Why do the numbers on a balance sheet matter? Even if you're not an accountant, imagine managing a budget that never balances or investing in stocks without understanding a company's financial health. It sounds risky, doesn't it? This is where a grasp of basic accounting concepts becomes not just useful, but essential. Start with the accounting equation, the very bedrock of financial reporting. Picture a scale in perfect balance. On one side, you have assets, essentially what a company owns. On the other, liabilities and equity, what it owes and what the owners have invested. This equation, assets equal liabilities plus equity, ensures that every financial transaction keeps the company's books in balance. Next, consider revenue recognition. This principle guides companies on when to record revenue. It's not merely about when cash is received, but when the revenue is earned and realizable. For instance, a contractor records revenue not when the client pays, but when the work is completed. Moving on to expense recognition, also known as the matching principle. This dictates that expenses should align with the revenue they help generate. If a company spends money on producing goods this month that it sells the same month, both the revenue from the sales and the expenses from production are recorded in the same period. This principle ensures the financial statements accurately reflect the company's profitability for that period. Now, let's differentiate between accrual and cash accounting. Accrual accounting records transactions when they occur, providing a clearer picture of a company's financial health. Cash accounting, on the other hand, only records transactions when cash changes hands. While simpler, it might not always reflect the true financial condition. Depreciation comes into play with tangible assets like machinery or buildings. It allocates the cost of these assets over their useful lives, reflecting the decrease in value as they age. This concept helps companies spread out the expense of costly assets rather than depleting their resources in one go. Similarly, amortization deals with intangible assets. It systematically reduces the value of assets like patents over time, reflecting their consumption and the benefit they provide over their useful life. Inventory valuation methods are crucial in determining how much the goods a company holds are worth. Methods like FIFO, first in, first out, and LIFO, last in, first out, can affect the reported earnings and tax liabilities significantly, depending on how costs fluctuate. Financial ratios, such as liquidity ratios, profitability ratios, and efficiency ratios, offer quick insights into a company's financial status. These ratios help stakeholders assess whether a company can cover its debts, how effectively it generates profit, and how efficiently it uses its resources. Cost-volume profit analysis is a tool businesses use to understand how various factors like changes in costs or sales volumes affect profitability. This analysis is vital for strategic planning and decision-making. Internal controls are systems put in place to protect assets, ensure accurate financial reporting, and comply with regulations. These controls are the safeguards that help maintain the integrity of financial data. Consolidation involves combining the financial statements of parent and subsidiary companies. This is necessary to provide a clear financial picture of the entire corporate group rather than just individual entities. Lastly, an audit is an independent check on the financial statements, ensuring they are free from material misstatement and adhere to accounting standards. Understanding these concepts allows anyone to navigate the financial landscape with confidence, whether managing personal finances or steering a corporation. These principles not only keep a company's finances in check, but also safeguard its strategic decision-making and long-term sustainability.